Our first session of the doubleheader is of topics to keep your nonprofit in the game, and it is focused on the financial reporting aspects unique to nonprofits. Ken Youngstead will lead this discussion. Ken is a member in the Assurance Services Department of KraftCPAs. As such, he is responsible for building and maintaining client relationships, overseeing the work of engagement teams, reviewing ongoing work, approving final reports, and presenting our work to clients' management teams and boards of directors. As a practice leader in the nonprofit and governmental industry teams, Ken works extensively with tax-exempt clients, including those that are subject to governmental auditing standards and single audit compliance. As a testament to his reputation in the nonprofit community, Ken served on the board of the Center for Nonprofit Management for several years and held the role of executive committee member, treasurer, and board chair. Ken enjoys hiking, running, and spending time with his family. You can frequently find Ken running races around the Middle Tennessee. And now I will turn it over to Ken to lead our discussion.
All right, so when we originally planned this seminar back in April, we thought a baseball theme would be perfect. Spring training camps were opening up, teams were gearing up for the season. Well, 2020 has been a little less than perfect, wouldn't you say? Our seminar, like baseball, went on a delay. And we feel like there's, a lot of value bringing people together in a room, not only for, presentation of content, but for the value that comes from talking to one another in person. But it still doesn't make sense to get together, but we are glad that you're here with us today, because I think the information is something that is hopefully going to be helpful to you all as nonprofit organizations. So again, we'll cover some of the accounting issues, and then a couple of weeks we'll talk a little bit more about tax issues. So as we go through the presentation, I'll just give you a couple of thoughts on what we're going to talk about today. Just a few general observations that I've read a little bit about on the nonprofit landscape. So I want to talk about that. The stimulus package accounting considerations. So many of you or your organizations may have received PPP loans or maybe other loans from the stimulus package. And so just recently, we're talking just a couple of weeks ago, we finally received some guidance on how we are to treat these from an accounting standpoint. So I'm going to talk a little bit about the accounting treatment. Fran is going to do a deeper dive in that in more detail, just about other provisions from the CARES Act when she does her program in a couple of weeks. But I do want to touch on the accounting, since it is going to impact many of you. So, and then there's a couple of new revenue recognition standards, one related to contributions received and contributions made. So I want to talk a little bit about that. And then the larger revenue recognition standard, ASC 606, and how it impacts nonprofit organizations. So ASC 606 deals more with exchange transactions for nonprofits. And then if we have some time at the end, we'll talk a little bit about some other updates that we have. So just talking about a couple of dynamics from the nonprofit landscape in general. So online donations, I mean, I'm sure you all have seen fundraising events that have all moved to, online formats rather than traditional in-person events. So, I mean, it is something that social media presence, crowdfunding, online donations in general, that's become increasingly important. I know personally, I've written very few checks over the last year or so. So even before we were dealing with the coronavirus and the elements of that, I still think that the presence of online giving has become substantially more important. And so you'll want to make sure that you address those needs with your organization, make sure that you make it easy for people to donate to your organization to be able to give funds. And so, that's just an emerging topic that we'll always want to keep our eye on. Talking about tax reform, there has been a push for a greater above-the-line deduction for individuals who are giving to nonprofits. In late 2017, when that tax act was passed, the standard deduction had, essentially doubled for most individuals and married couples. And so many people who used to give and itemize their deductions are no longer doing so. And, one thing that came out with the CARES Act that is a bit of good news, although the amount is somewhat nominal, there is a new $300 above the line deduction that came in as part of the CARES Act, where people, even if you're not itemizing deductions, you can get some charitable contribution that's deductible. In addition to that, there's a 60% AGI limit for contributions that's been lifted for 2020. So hopefully that could certainly help encourage giving. But quite honestly, I think the dynamic that we've seen in the industry in general is that that may help your larger dollar donors, maybe not so much the smaller dollar donors. So when we talk about the AGI limit and that, there's going to be, most people are not going to be impacted by that. The other thing that we've seen a lot, and I've read quite a bit about of recent, is just the increased use of donor advised funds. And so I do want to make this point to you all because it could help with giving strategies as you approach donors. More people are setting up donor advised funds. Certainly we have a community foundation here in Middle Tennessee. There are other foundations that, that also do donor advised funds, and it really could be a cultivation strategy that makes sense. But I think also from an accounting standpoint, there's a couple of specifics that I think you all need to consider. And, so I'll list a few of those. So donors can't receive benefits from a gift given from a donor advised fund. So if they were purchasing a table at a fundraising event or a virtual fundraising event, I guess today, the return benefits that you get from a donor advised fund gift, you really are not supposed to do that. So, just be aware if you're receiving funds from a donor advised fund to make sure you stay on course with that. Also there's a dynamic where a donor advised fund really can't fulfill a personal pledge. And so the reason I think this is important to you all, if you're doing some kind of a campaign where you're reaching out for multi-year gifts and you've been given a pledge by a donor who is using their donor advised fund, you do need to know that that the gifts, you can't record a long-term pledge from a donor advised fund. The individual can make that commitment to you. And, if they are choosing to pay that through their donor advised fund, I just think the communication is important on where the money is coming from. Those foundations aren't going to make a long-term commitment and really can't and shouldn't. And so just be aware if you've got a gift that you're receiving from a donor advised fund. And then, also, when you do receive those gifts from those donor advised funds, you'll actually just record it as the money comes in. You wouldn't have a pledge. So, also budget considerations. Just a couple of words about this. The global pandemics created a lot of uncertainty this year with nonprofit organizations. It's, I'm generally one that really feels that when you set a budget at the beginning of the year, unless there is some drastic reason for a change, that you should really kind of stick with your budget. And to the extent you've got things that are over or under budget, your budget to actual report kind of tells a story. But with the global pandemic this year, I think things are quite a bit different. And I think reevaluating your budget from a planning standpoint is likely very important. You do want to make sure that you are totally prepared, especially from a cash flow standpoint, just making sure that that you make good, solid decisions on that. So I've heard more this year about nonprofits actually revising their budget approach mid-year than ever before, and quite honestly, that's a pretty important consideration given today's world. So something else to keep an eye on is government funding. Federal, state, local funding. Budget battles are taking place all over the board at those different levels, and it's a little bit unknown on where that is going to take us. It's a highly political time on these state, local, and federal levels, and strains on resources. I mean, just like many of your organizations have been profoundly impacted by the coronavirus and the impact of having to shut down or change the way you deliver your programs, governments are having to do the same thing. Sales tax revenues, all kinds of things are different for these government agencies. And so, I don't know what all that's going to shake out to look like, but if you receive a lot of these grants, I think you should certainly watch that closely and have good communication with your funders. So speaking of that, really other funders, I'm on the board of an organization that receives a grant from a private funder, and the program that was going to take place for that grant really weren't able to do that. And so I think it's really important that good communication and honest conversations with those funders are going to take you a long way in trying to determine the best approach to how you handle the money that you receive from them or what you really need from them. And I think your funders are really going to want to listen to your story. They know that things are different today as well. So just keep that good communication going. So, as Fran mentioned early on, if you are here for CPE and need credit, there's an evaluation form that was sent to you yesterday that has a place to enter in 3 keywords at the bottom. And so the first keyword is CARES. We're going to talk about the CARES Act in just a minute. And so jot down this first keyword if you need CPE credit for today, and there'll be 3 of these. I'll make sure that it's very clear when we get to those. So CARES is our first keyword. Okay, so as we move into the accounting considerations, the first thing, the Paycheck Protection Program loans, boy, did this get a lot of traction. And there has been a lot of talk and not a lot of clarity about many aspects of this, this program. But more and more, we're starting to get additional guidance. And finally, just recently, the AICPA issued some guidance on how to treat these loans from an accounting standpoint. So the question is it a loan on your books? Do you treat it as a loan, or you treat it as a conditional contribution? And the answer is that you have some options, and we're going to talk about those in a little more detail on the next slide. I think this will be important for you as you go forward. Single audit considerations. Some of you all receive other grant funding. You might be under the single audit requirements and guidance already. But it is important to note that to the extent you've received a Paycheck Protection Program loan, that does not need to go on your CFA and does not count as federal awards. You're looking at a $750,000 benchmark that might require you to have a single audit. This will not add to it. Now, if you all had received the economic injury disaster loans, the EIDL loans, those are considered federal awards, as I understand it. So there'll still be some additional guidance coming on that, but some of these other programs might actually require consideration in terms of where that may land you. But the Paycheck Protection Program loan, they've said no, it does not add to your, to your dollar threshold looking at the single audit requirements. So that's good news. We were really concerned about that, but that's been clarified. And then forgiveness considerations. This has, there has been so much guidance, coming through on how the forgiveness is going to work. And all that. So there's still an uncertain road ahead. And I'll say particularly with federal funds, the one thing that they have said and they've made crystal clear is that you can't double dip on expenses that are going to be reimbursed under your federal awards or your federal programs and the Paycheck Protection Program costs. So if you have salaries that are part of a federal program that you get reimbursed for, you cannot use those same salaries in the forgiveness calculation for your Paycheck Protection Program loan. So you can't double dip there. As I understand it, many of the federal agencies have yet to issue specific guidance on how those other costs are going to coordinate with their grants. There is some talk and some thought about, by you being able to reallocate a portion of your grant funds, your federal grant funds, towards other expenses, and then you actually use salaries, and exclude those from your reimbursement requests on the grant funds and use them for the Paycheck Protection Loan forgiveness calculations. So something to keep in mind there as you go through. You'll want to, try to, gather as much as you can about that. I do know that the double dip concept is something that you'll need to stay clear of. So I hope that makes sense. All right, so the AICPA guidance on the accounting for Paycheck Protection Program loans, it basically says that you could use either approach. You could either treat the Paycheck Protection loan as debt, or you could treat it similar to how you would treat a conditional contribution. So the first talk about the debt approach. So if you're treating it as debt, obviously you record that as a liability on your books. You do have loan repayment provisions. You would basically record, once you filled out your forgiveness application after the period of time, and you submit that to your bank. Once you have received a legal release from that debt, that's when you would actually record that amount as income on the books. So you'll need the legal release in that case. So if you are expected, if you're going to treat this as a conditional contribution, then basically once you, and I'll move to the next slide here, the conditional contribution treatment for PPP loans, initially you record these proceeds as a refundable advance. It's still a liability on your books, very similar to debt. And you'd reduce that refundable advance and recognize the contribution once the conditions of release have been substantially met, or explicitly waived, but substantially met. So once you've paid that payroll that is going to qualify for forgiveness, or paid those rental payments or utility payments that qualify under the forgiveness calculation, you would go ahead and recognize that forgiveness at that time. So I've got a warning here. If you have a June 30 year end, you need to consider these options carefully. We've been given now a revised 24-week period to be able to do to meet the forgiveness guidelines. And that is designed to make things more flexible. It's designed to allow agencies to have a greater chance of forgiveness, and businesses as well. And so at June 30, I suspect many of you, if you've received these loans, you're right in the middle of your forgiveness period at June 30th. And so you also may be, if you'll reflect back on the conversation that we had about, about coordinating with federal grants, you might have a situation where you're, where it's a little murky. It's a little bit of a gray area on what to record as forgiveness along the way. So what I've heard suggested, and I think this is a really good idea, is that if you are going to elect to treat this as a conditional contribution, that you may want to have some kind of a matrix, something that you put together that actually schedules out the salaries that you're actually asking for reimbursement under grants, and then salaries that you're going to actually use for the PPP loan forgiveness calculations, and just make that clear and concise. Again, we talked about very little expense coordination guidance that's out there now. The other element that I'll just throw out there to you all is whether you've got other grant funders who have, and I'm talking about maybe private funders or something like that, where they are reimbursing salaries under a grant that you have with them. There is no guidance on how to treat that. And again, I'll reflect back on the suggestion I had earlier that good communication with your grantors is important. I don't know what the expectation is going to be from your other grant funders if they are specifically paying salaries. Are they okay with you actually using those same salaries under a forgiveness application for the Paycheck Protection Program loan? That's a little tricky, and and unfortunately, there's not a real clear answer for that. So we'll continue to watch and keep you posted on what we hear, but I think that's something that you all need to consider as well. I do like the fact that they have extended this period to 24 weeks because I think that is going to make it substantially easier to navigate around the coordination of those salaries. And I'd really encourage you to use that longer period if you can. And if you clearly meet the forgiveness provisions during the course of that 24 weeks, and and you feel like you can get 100% forgiveness, you're able to apply for that forgiveness earlier than that 24 weeks. You don't have to wait till that period is over to apply for forgiveness. So the SBA has issued a little guidance on that as well. So any questions on the PPP accounting considerations, Fran? I don't know if there's anything that we have in the chat box that
we have nothing yet.
Okay.
So.
Great. Okay, so the next section that I'd like to spend a little time with you all on is revenue recognition. So there are really two new standards that that are out for this year. This ASU 2018-08 specifically deals with clarification of the scope and accounting guidance for contributions received and contributions made. The goal of the standard was to reduce the diversity in practice on how, grants and contracts are treated by nonprofit organizations. So, the revenue recognition standard for contracts with customers that we're going to talk about shortly has been deferred for a year, and we can, we'll talk about that in a minute. But I do want to make it clear that this particular standard has not been deferred. This is effective for 2019 calendar year ends and after. So, this one actually is in place. So it provides, guidance both for resource providers and recipients of grants and contributions. So if you are a grant maker, this also applies to you on how you would treat these. So this is a flow chart, and we won't talk about this in detail, but it is in your materials for you to refer back to. I've got some slides that basically cover these points, but it is a visual that could be quite helpful in outlining the order and the steps that you need to go through as you assess these revenue decisions. And, I think it's beneficial if you have a grant agreement or some other kind of revenue stream to take it through this flow chart to see where you land. We'll talk about, there's really three key decisions that you have to make throughout this process. And so we'll look at those each one by one here as we go through. So the first step is to decide whether your revenue stream is a contribution or an exchange transaction. So an exchange transaction, your recipient, you all as recipients, and the resource provider, you're exchanging resources for goods or services that are of equal or commensurate value. So if you're basically providing a fee for service, that's an exchange. And, if you do have an exchange transaction, then you actually apply this ASC 606, that we're going to talk about shortly. It's not a contribution. You have to consider, here's one of the really unique elements and one of the clarifications of the standard. This is really an enhancement of the information available for existing guidance, so to speak. So if you have a resource provider that is receiving benefits, then it's an exchange. So if you consider, consider foundation grants, does the foundation that you're receiving the money from, are they receiving a direct benefit in return? In most cases, that's going to be no. The answer to that question will be no. It's going to be considered a contribution. So a little more information about, the exchange transaction. When you have a grant funder, there's a couple of examples that we have in the materials here. And, this new guidance has basically clarified that, the resource provider is not synonymous with the general public. So in other words, if you're receiving a grant from a government agency, and that grant is basically benefiting the welfare of the general public, that is a contribution. On the other hand, if you have a government entity that's, that's basically receiving, if they are going to use the work that you're providing in return for providing you this funding, then they may be an actual recipient of the exchange. So, so again, you just have to look at the resource providers. Are you actually providing something for them specifically in return? And this guidance also says that if you have, an agency that's receiving, or they're basically a third-party payer on behalf of an identified customer, something like that, then that is actually an exchange transaction as well. So an example of that may be if you're receiving money for low-income housing assistance payments that are going to help specific tenants of an apartment complex. So you've got an identified customer in that case, even though the agency that's providing the funds is not receiving the benefit. There is an identified customer that's in the background that is receiving that specific benefit. So that's an exchange transaction, not a contribution. So, otherwise, if it's not an exchange, then you have a contribution. So the second step of this is to decide whether the contribution, if you do have a contribution, is that contribution conditional or unconditional? So this standard redefines conditional. So and again, if you do have a conditional contribution, you only recognize the revenue once that condition has been satisfied. So if you think about your government grants, if there is a right of return or a release of obligation that's in that document, in other words, you don't spend the money, spend all the money in that grant the way it's outlined, do you have to return that money to the funder? If so, that's one of the two criteria that you must meet for it to be conditional. The second thing is that there must be a barrier to overcome, and we're going to talk more about barriers on the next slide. If a barrier is not overcome, then the funds have to be returned, and so you really have to meet both of these criteria for it to be a conditional contribution. And again, if it's a conditional contribution, you only recognize it once that condition is satisfied. So does a barrier exist? Here are the considerations for barriers. If there is a measurable performance barrier, such as the number of people that you're serving. So I'm giving you a grant to feed these 100 hungry people. That is something very specific. They have a specific level of output, a specific service that you're providing. That's something that's considered a barrier. Another barrier might be a matching requirement. So if you receive a grant that basically says, I'm going to give you $5,000 if you raise $5,000, under this fundraising program, something like that. If you have a matching requirement, then you actually have a barrier. If you don't raise that $5,000, you won't get the other $5,000. So you don't recognize this donor's $5,000 gift until you've actually met that barrier or condition. Once you've met it, then you recognize the revenue for that. So, that's something that you'll want to read your documents closely and see if there is a specific protocol on how you're spending the money. See if there's actual, barrier type language in there. And then, of course, you'd also want to see, and usually this is pretty clear, that if you don't spend all of the money, if there's a right of return that also exists. So two things that you definitely have to keep in mind. The one thing that doesn't, that is not a barrier, is if you have to provide a budget report, some kind of follow-up report telling that funder how you spent their money. That's more of an administrative requirement. It's a report explaining how the funds were used. You might have to provide a budget that shows what line items or categories that you used. And so those administrative requirements are not considered barriers. So if you really only have to report back to a grantor how you spent their funds, but they didn't provide very specific guidance on how exactly they want you to conduct that program, then you don't have a barrier in that case. So once you've met the conditions of your conditional contribution, or if you have an unconditional contribution, the next thing that you have to do is just evaluate your donor restrictions. Do you have donor restrictions? Is this for a building project? Or is this for a specific program that your organization conducts where you treat it as donor restricted dollars? So that really has not changed from how you might record those items or track those items before. So you do need to, in this third step, just consider the the contributions and whether they have any donor restrictions on them, on how you use it, or the time period it represents. So a couple of examples that I want to step through. There's 3 in your materials here. We'll talk about the first 2, the others just there for your reference. Better Education Think Tank receives funding from a local government to perform research, a research study on education benefits and the drawbacks of a 4-day school week. The government, who is providing the resources, hopes to save money by reducing the school week by a day with no detriment to educational quality. So this agreement requires Think Tank to plan the study, perform the research, analyze the research, and submit an analysis and the conclusions to the local government. So the government's going to retain the rights to this, and they plan to use this in hopes to make decisions about whether to go to this 4-day school week. And so remember, the step 1 thing that we're looking for, is this a contribution or an exchange transaction? And I think that's what's critical here. The government, who is providing the grant to perform this study, they are doing this because they want your study results. They want the information that you're going to put together and provide to them on the dynamics of a 4-day school week and how that's going to work. So they are actually receiving something in return for their dollars. They're receiving a benefit. And so, as we look at this particular grant, this would be an exchange transaction. You record it as the services are provided between the parties. So, I think that's a situation that you could certainly have. You need to look at who's giving you the money and whether they receive a benefit in return. So here's another example. A community association, it's a recreational organization that's providing sports programs to residents. This association received a $40,000 grant used to initiate or start a tennis program. So this grant includes stipulations about hiring instructors and providing a summer camp to really get this program started. But the agreement doesn't specifically tell the organization how exactly to conduct the program in this case. So they they're saying that the entitlement to the $40,000 is dependent on meeting basically starting this program and using the funds towards the tennis program. There's a right of return in this case for the grant for any funds that are not spent on the program. So they've got that right of return in place. And so how would you treat this? And there's a few different options. So the grant that they received, there's not a direct benefit going in exchange for this from the resource provider. So it's a contribution. But now, is it conditional or unconditional? While there is a right of return, in this case, they have not specifically said how exactly the association is to run the program. And so that's really an unconditional gift. And then you have to look at your third step as to whether it's restricted or unrestricted. Well, the mission of the organization, it's they hold recreation activities for the public, but they're not specifically organized to run tennis programs. This is more narrow in focus than the organization's mission as a whole. So I think this is a restricted grant in this case. So it's a contribution, it's not conditional, but it does have a donor restriction because they want you to use it on the tennis program. So you need to step through those 3 different steps to come up with that result. So I hope that makes sense. Then there's another example that you can look at, at your leisure later on. Great. So our second keyword for those of you who are looking for CPE today is revenue. Been talking about revenue, contributions, and now we're going to talk about exchange transactions.
Hi, Ken.
Revenue is the next keyword. Yes, Fran?
We did have one question.
Sure.
So if, a couple of questions actually. So if you had a PPP loan and you received the funds prior to June 5th, are you required to get back to the bank to agree in the change of the number of weeks from 8 weeks to 24 weeks to use the funds for payroll in order to have the loan forgiven?
Yeah, that's a good question. And Fran, you might actually have some thoughts on this. I know you are able to do that. If you received your PPP loan before June 5th, you are able to make an election. Now, you might actually have to tell your bank that you're doing that.
I heard
So
a
it's like a
few,
slight modification to your
right.
agreement.
I did hear a few things at the AICPA conference last week, and they did say that if you don't talk to your bank, a lot of banks will automatically assume that you're going for the 24. If the 8 weeks is up and they haven't heard from you, they're going to switch it to the 24. I think that's a little risky because you're making a lot of assumptions. I would definitely reach out to your bank if you're going to change to the 24 weeks and just confirm that. We also had another question, Ken.
Okay.
What would the recording of example 2 look like? So going back to the example 2, how would that be recorded?
So you would actually record this grant as a contribution. You'd recognize it all up front at the date of the notification that you've received the grant, the award, and you'd record that as a donor restricted gift, as a net asset with donor restrictions, essentially. And as you actually spend the money on this tennis program, if you think about your audited financial statements, there's a reclassifications line where once you've met the purpose or time restrictions on a gift, you'd actually reclassify that to your net asset without donor restrictions column. And so you would just need to track how much of the money you've spent. And if you do cross a year end, you haven't spent the full $40,000, you still have recognized the entire $40,000 during the fiscal year it was awarded, but you might have some amount that is left over in your donor restricted net assets that you would spend in the next fiscal year. Okay.
Ken, we have one more question.
Sure.
Based on the first example, if a grant has 3 deliverables in the study, holding info meetings with parents and providing professional development to teachers, can a grant be some exchange and some non-exchange?
Absolutely, it can, yes. And as we talk about the revenue recognition standard, that's a terrific question. As we talk about the new ASC 606, it actually talks specifically about allocating, separating all the different performance elements. In this case, instead of a performance element or a performance obligation in the revenue stream, you're actually carving some of that out and running it through the contribution guidance instead of the earned revenue guidance. But you could actually allocate different portions of a grant, both to contributions and to exchange transactions, and record them in accordance with those respective treatments.
That's all the questions for now.
Yeah, great. And you might have to estimate that. That's another key piece of this as well, is you could have an estimate that you need to factor in here. So I'm going to talk about 606. We're going to go through this information kind of quickly, but there are a few things that I want to make sure that come across here. First of all, this was new guidance that was supposed to be implemented this year for all organizations. We got a curveball with the coronavirus, where the FASB has actually issued a 1-year delay for implementation if you haven't implemented the standard as of yet. So if you are a calendar year end and you desire not to implement it this year, or certainly if you're a June 30 year end, whatever your year end may be, if you've not issued financial statements with this new guidance in there, you've got the opportunity to defer it 1 year. You can still adopt it this year if you choose. And it's our intention as a firm to work with our clients to do what they'd like to do. And I think if you have a relatively simple implementation, some of your organizations will, some of you, it will be kind of painful to implement, to be quite honest. We're going to give you the choice, but we are definitely willing to work with you and go ahead and implement this new standard this year. So I'm going to put up Tara, if you could put up a polling question. Interested if you have implemented the guidance yet, or whether you'd like to delay it a year or keep it going. So you should see a polling question here. This is not for CPE. This is mainly just for general interest. You see you've implemented the new standard, or you've not implemented, but you plan to implement this, this upcoming year, or if you'd like to defer it. an additional year, which is now a new option due to the coronavirus. So take a look at that and be interested in your results there. And as you're answering that question, I'll go ahead and tell you a little bit about the transition approach. You know, the modified retrospective approach is one that I've seen used fairly often, but it's, you know, where you're not restating, if you're doing comparative financial statements, you're not going back to the prior period and actually recasting those financial statements for this new revenue recognition period as well. So the modified retrospective method is one where you actually restate your current year financial statements in accordance with the new standards. And then you have a beginning balance adjustment at the beginning of your fiscal year and a footnote that discloses all of the elements of the adoption of the new standard. So either of those approaches can be used. So Chair, if you want to go ahead and close the polling question and show us the results. So interesting that we've got a little bit of a mix between items 2 and items 3 about wanting to implement it this year or deferring it to next year. So certainly that's you know, something that we'll work with you all on as we go forward. And then some of you, it was already well underway and we've issued financial statements. So, so it's good to know, good information. So if you can close out that poll, that'd be great if it's not closed already. And so a couple of things, you know, this standard, the places that I've heard, you know, in some cases I mentioned a pretty simple implementation. Many of your organizations are going to have revenue streams that are pretty clear on when you recognize the revenue. It's still going to be when it's earned. And so unless you have a lot of different elements in a revenue stream, you know, it's going to, you know, whether you're recognizing it at a period of time or over time, you know, sometimes it's going to be pretty clear. The places where I've seen a little more work that needs to be done, if you have membership dues, there might be several elements, several benefits that come to membership dues. You have to break those apart and analyze those revenue streams. Naming opportunities, sponsorships. You know, if you're a school and you have tuition and fees, there are likely different elements that you're providing for those tuition enrollment payments and things like that. So really any fee for service is what this relates to. And to the question that we had earlier, you can see a single transaction can have both contribution and exchange elements. And so you might need to separate those elements and run it through the particular guidance. So membership dues, we kind of talked about this already, where you could have, you know, a journal, you could have discounts at a gift shop that you might need to break out separately. There might be advocacy efforts that you provide for your members, discounted or free seating to events, you know, if your organization is set up like that. So you can see there are situations where you have to break out all of these different elements from a revenue recognition standpoint. There's a 5-step model. We're going to talk very briefly about each of the 5 steps, but you know, it's identifying what your contract or what your arrangement is with your customer, and identifying all the performance obligations. You saw the membership dues description and what all could be included there. So if you have multiple things wrapped up in one contract, you have to break those out. Determine the overall transaction price for this arrangement. And then you allocate that transaction price to the different performance obligations based on estimates or information that you have. And then you recognize the revenue when each performance obligation is satisfied. So in the most simple, you know, just giving you a couple of thoughts, in the most simple scenario, if you just have, you know, merchandise sales or something like that, and you don't have a real complicated implementation, you know, at a minimum, we'd still like to have some kind of a memo that we can work on with you, or, you know, you can work on that just describes how you receive revenues and whether you're receiving them at a point in time, whether you've earned them at a point in time or over a period of time, and how those are going to be treated. So there might be some situations where you've got multiple elements to break out of different revenue streams, and so you might need to put together a schedule in those cases where you've got your revenues, your arrangements, and you've broken out and given some thought to a format of how you recognize that over the respective elements that you have. So You know, so identifying the contract with the customer. I think the key point that I'd like to make here is that you do have to have the ability and intention, you know, by your resource provider to pay for those goods and services. I think a good example of this that is just easy to understand is, let's say that you have a hospital and you have a patient that's admitted that that really doesn't have the financial resources, but they are receiving services, earned revenues. You know, they don't have the ability, you know, to pay that. You wouldn't recognize that that revenue in the first place, because you do have to assess the ability and intention of, you know, to receive payment on that contract. So collectibility criteria is important. Identifying the performance obligations. This is also pretty straightforward. Breaking out every component that you have in a particular arrangement with a customer or a member. You know, so you account for all these distinct performance obligations separately. Tickets to a gallon, discount to a gift shop. You're not assigning the value to those just yet, but you do need to break these out and identify what all you have to do. These are more things that could be performance obligations under a contract. Determining the transaction price, the overall transaction price. In most cases, this is going to be pretty clear, but in some cases, you could have variable consideration in there as well. Performance bonus or penalties or price concessions, you know, things like that. I think there's a good example of a price concession on the next slide here. Maybe not the next slide, but coming up. So you're determining the, you know, if the consideration is variable, you'll need to estimate that. What is the most likely value that you're going to receive under that contract, you know, with the customer? So you could use any of these approaches, probability weighted approach, like what is your most likely value that you're going to receive, or you could, you know, have the amount that, you know, do a probability weighted analysis as well for that. Now it's time to actually allocate the transaction price to those different performance obligations. So the key to allocating the transaction price, you know, you might need to look at the standalone selling prices of each distinct good or service. If you do provide those separately, what do you charge for those? You know, it could be that you have a situation where if you charged all separately for all of these different performance obligations, it might add up to something that is greater than your contract value that you have in this particular contract. And that's because you've got, you know, essentially almost like a volume discount that you're provided. It's a sponsorship package. And because they're giving you all this, you're throwing in different elements that are exchange elements into the deal. And so you might need to do some kind of proportional allocation, you know, of that selling price, which is what's spoken to here, allocating the sales price proportionally to all of those different performance obligation elements. And then finally, you recognize that revenue once you've satisfied that performance obligation, and you need to look at each one separately. So I think it is important, because the guidance has spoken somewhat to memberships, that there's now more of a focus on when the customer consumes the benefits than what you have to do. I think there could be an argument made that if you have a membership that just provides you know, and this is under the old standards, you could have a membership that provides a, you know, a $2 discount to admission, or maybe a free admission or something like that, where really all that your organization has to do is open the door and let people in. You really don't have a substantial obligation that you have to meet. You just have to allow them in. And so many times those memberships were recognized up front. I think this new guidance has pushed more towards a situation where you look at the period of time that that customer has the ability to consume that benefit, whether they take advantage of that or not. So, you know, so memberships you might see more spread across the year in a lot of cases. So that's something to keep in mind as well with this. And then to the extent you've got a timing difference of when you've received payments and when you've actually recorded or met those performance obligations to receive the revenue, you might have an asset or a liability that you need to record on your books. You know, the liability might be similar to a deferred revenue. You know, you've received the money, but you haven't earned it yet. So you've got a liability out there. Or it could be that you received all the money up front, but you've yet to meet some of the performance obligations that are in that contract. So you could have a contract asset or liability in that case based on the timing of when you're receiving the payment to when you've actually provided the services that you're required to provide under that. So you don't have to necessarily call it contract asset or liability. You can call it whatever makes sense on your financial statement, but that is essentially the concept of contracts, assets, and liabilities is truing up the timing of the payment for the services and when you've actually provided and earned those respective services. So presentation and disclosure, a few items here. You know, you do need to disclose the nature of your performance obligations, whether you record them at or recognize them over a period of time or at a point in time. You know, if there's any significant judgments that you've had to make in terms of how you record those revenues, and then any contract assets, you can see the you know, the disclosure requirements there. So an enhanced disclosure for revenue than what we've had in the past. So here's our third and final keyword that I'd like to pass along to you. The third word is deferral. So the reason I thought this word was great is that we have the opportunity to defer implementation of revenue recognition, the ASC 606, 1 additional year if you choose to do so. So if you are looking for CPE for today, this is your third and final keyword, deferral. So be sure to jot that down and include that on the evaluation form that you'll provide back to us. So other topics, you know, and this one is real simple, but the presentation of restricted cash, you know, on the cash flow statement, there has been a diversity in practice over the years about whether you're including something like a restricted cash account in your statement of cash flows, if you've got a capital campaign bank account that you've got, you know, separate where you're holding funds for something like that. You know, there have been different approaches to how you actually reflect that on the statement of cash flows. Now, if it's cash, it goes in your statement of cash flows, period. So it is included in your beginning and ending cash. And you do have the opportunity or ability to present a footnote or a schedule at the bottom of your cash flow statement that actually shows what comprises your cash balance. So you could talk about restricted cash accounts or escrow accounts, whatever they may be. But they do belong in your beginning and ending cash in accordance with this standard. So that's effective this year as well. And then I just wanted to say a couple of words about the financial reporting standard that we've talked about, you know, last year and really year before. This was something that was required to be disclosed in 2018. I've heard lots and lots of discussions from board members and really from other people in the profession about this liquidity standard. And so just wanted to make a point or two here that basically says this standard still, you know, there's going to be some agencies that, or maybe grant funders that look at this information and it kind of tells a story about, you know, your cash position or your sustainability as an organization. And so I do think it's important for you all to look at this disclosure closely. There is an opportunity for your governing board, your organization, to really kind of help make sure you send the message that you want to send, the right message about how you actually manage your cash flows and your liquidity. So, you know, if you do have a board of directors, you have the ability for your board to actually designate assets for certain purposes. It might just be for long-term investment. It might be for future capital purchases. It could be literally just setting up an operating reserve that's set aside for, you know, for situations or needs like we've had this year. so you all might want to consider whether there is any board action that you would consider necessary to make sure that you are sending the right message from a liquidity standpoint. So I think the other elements of that new financial reporting standard were actually really good, really helpful. This is really helpful too, but is really the item that has generated the most discussion. So just wanted to just bring up that point. And I've got a couple of slides here about disclosure requirements and what's included in this. I think it's important to note that the number that is at the bottom of this schedule, this liquidity schedule, is the financial assets available for general expenditures, and the standard really didn't define general expenditures. So so it's just important to be clear in your policies on and that disclosure, what that number represents, and how you approach liquidity within your organization. So Fran, I might turn it back to you to see if we have any questions that we might need to cover from the chat.
And we do not have any other questions that have come in. I just want to remind everyone of the 3 keywords: CARES, revenue, and deferral.
Great, great. Well, listen, certainly appreciate you all spending an hour with us today. I do want to remind you again of Fran's session that I'm sure will be quite popular, to hear more about some of the stimulus package considerations that we've got. Boy, it's been a complicated year for you all, not only from just managing these accounting pieces, but more so just trying to make good decisions as your organization navigates our current time. So, here's hoping that we can have an improvement of what's going on with the coronavirus, and that we can get back to normal. But there's still going to be work to do. So we've got an interesting year ahead of us, I think. Listen, thank you all for for joining us today. And if you do have any additional questions or want to reach out specifically to us, my email address is here. I think you all probably all know how to get in touch with us. We are more than happy to talk with you about your specific situations as you get ready to adopt some of these new standards, or deal with any of the other issues that you have. So great. So I want to thank you all for for joining us here.